You want to start off by talking about policy, and I guess when you say that, you mean Fed policy, the central bank, right?
Yes,
And
exactly.
how that
Yeah,
impacts us as investors.
the theme is really growing but slowing. And that all feeds into why we are having the discussion in 2019 about the Fed cutting rates. It's not raising rates anymore. Now we're talking about what would happen if the Fed cuts rates and why would the Fed be even talking about this when we've only raised rates 9 times throughout this cycle. And from 2004 to 2006, we raised rates 17 times.
Hmm.
So, very different place that all of a sudden we're saying, no, no, we need to lower rates down because we need to stimulate the overall economy. Now, the Fed is trying to take everything into consideration. As you probably know, Jason, their dual mandate is that they need to maintain maximum employment and price stability. So the Fed's looking at those indicators and they're saying, well, if you look at unemployment, we are close to a 49-year low and everything looks great. The employment market looks like it's on track. And the Fed's not silly enough to just look at this number and say, yeah, we feel good about this. They actually see some confusion in the data because over a year and a half ago, we crossed the point that there are more job openings than unemployed people to fill them, which would say the labor market's really tight. You got to be
Mm-hmm.
giving people more money. You got to be raising wages. And that chart in the bottom right is showing we're still at 3.1, 3.2% wage growth.
Right.
And that's
And
after.
Allie, when you talk about wage growth, and like Americans haven't had a raise since 1977, right? But recently, and maybe to Trump's credit, there have been some increases, but they're not enough to keep up with the
No.
cost, certainly of housing only, right?
Yes. Yeah. And we'll hit on the difference between inflation, home prices, and wages a little bit later. But to your point, if you look at wage growth minus inflation, then you're maybe getting so how much the price of goods of items that you're buying is going up. You look at that difference. No, people are not getting huge wage increases that make the cost of living just all of a sudden easier. So the Fed then, when they're looking at maximum employment, they're saying, we don't know for sure that we're doing the job right because some of the stats look fantastic and some of the stats are still leaving them scratching their head. What's going on? They also want to look at inflation, where if you look at inflation over time, you want to be at 2%. That's your target level that prices will generally go up. Again, you would generally see wages going up over the same period. That's fantastic. But we haven't consistently been at 2% inflation since 2008 and before. And so this is a problem because the Fed is basing their policy decisions on the fact that businesses are raising prices and we're seeing that broad increase and we're not seeing it.
Mm-hmm.
And so then the question is, we created this inflation index, say over 30, 40 years ago.
Right.
And is the economy the same place that it was 30, 40 years
It's
ago?
definitely not. And Allie, that's so interesting you bring that up in your presentation because, of course, all of our listeners will say, well, look, the official inflation rate is not the real inflation rate. It's always understated. Most people agree with that nowadays. How much? It depends. It depends. Everybody has their own personal inflation rate because we all have different spending patterns. But an interesting article I read just this morning was that Goldman Sachs is claiming that people are not counting and evaluating the economy correctly. They don't evaluate, for example, all these free services we have, like the Google products, in the GDP. Right, and what I think is a really, now this is me talking. I would agree with that on its face. Okay, the Goldman Sachs thing, but then I would also say, yeah, we're not evaluating that we get all this stuff for free, like the free Gmail, free this, that, and the other thing, and not just Google, but lots of companies offering free things. But we're also paying for that. And we are the product. We're paying with our information. There's a big rebellion against this nowadays. Thankfully, it needed to happen. Facebook is not free, really. You're paying with your information, and nobody knows how to account for that yet. But it's not counted as part of the GDP, is it?
No. And that's same with, you can see in the bottom here, the technology. So now we have our iPhones that replace your need for your clock or your recorder or your
Right.
GPS,
Oh, yeah,
where
good
in the
point.
past, maybe
Yeah.
they were raising prices. And now you have it all in your fingertips. And again, that's under the free category of having it in your phone. We have Amazon, where you go to the store. I almost bought something for $30 and found it was $12 on Amazon and said, okay, I'll wait a day. So is the 2% target, whether or not you agree with how it's measured, should we even be looking at that? And is 2% the right target? And if it isn't, are we making policy mistakes by not actually changing policy to adjust for how the world has changed?
We could have a 3-day discussion on just this issue. But what do you guys think over at Myers Research? I mean, do you have an answer for this, or is it kind of a rhetorical question? It's an awfully big question.
I do think it's a bit of a rhetorical question, because I don't think I will try my hardest to try to change policy, but even GDP is measured the same as it was in the 1920s. Mm-hmm. And so is the economy the same place as it was
Definitely
that
not.
long ago,
Yeah.
right before the Great Depression? No. So this is the whole point of that, is saying the job growth picture is more fuzzy than you would initially think. Inflation, not even the Fed knows what the heck is going on with inflation, and that makes things fuzzy. And that puts us in this really weird position that the Fed then needs to step back and say, that's my dual mandate, but what else is going on in the broader picture? And the answer is, we saw the tax reform bill, awesome, gave more money back to Americans in a lot of markets, maybe not so much where I live in California, but there are other markets that saw a big benefit from the tax reform bill. And we saw CapEx really grow. Businesses investing in factories and in manufacturing and in technology right after when they got that bump from the tax reform bill.
And bonuses to their people too. I mean,
Yes.
Yep. Yeah, it's
and we've seen that was everyone. If your listeners hear about the sugar high, mm-hmm. that's what we saw during that period. You saw a lot of increased investment. This was awesome. And now you're seeing that first quarter numbers coming down. And yes, it's still positive year over year. So just mm-hmm. keep that in mind through all of this, is as we talk about, is the economy going into recession? Are things you're worried about? These numbers are still positive. And the fact that you still have positive growth here based off of this as your comp mm-hmm. is actually good, but we are seeing a shift in overall activity.
Okay.
Same with retail sales. This data just came out and it's at 3.4%. Retail sales is important to look at because 70% of the economy is consumers. If you're trying to figure out direction of growth, you got to be looking at this. 3.4% sounds good. Again, it's still growing, but you can see again on the chart, we were growing 6-7% with a historical average of 4. So you are starting to see a little bit less activity on the consumer side as measured by retail sales, which can put you a little bit on alert, but it's not to the point that it's negative or necessarily worrisome today. And again, you can look across other sectors. I won't dwell on this, but the auto sector starting to see a slowdown, the manufacturing starting to see a little bit of a pullback. So mm-hmm. broad-based, Fed is looking at all of these different indicators and saying things look slower, and this makes us nervous. Mm-hmm. Beyond that, they're going to look at home sales.